Let's talk about LLC taxes when operating in multiple states. I first want to give you a shortcut, and then I will give you a detailed explanation. So the shortcut is that having an LLC in multiple states actually is kind of straightforward when it comes to taxes. So as a business owner, you may live in a different state than where you work, or you may be looking to expand your client base into another state. You may have heard that some states have better tax situations for LLCs than the one where you live and operate. Or you may have customers in other states and are wondering what the requirements are for doing business in multiple states. The question is, are you actually even required to license your LLC in any state where you do business? What are the tax implications of operating in multiple states? So in today's conversation, I really want to cover all those things so you have a clear idea. So when you're done, you have a clear idea what you really need to do. So in terms of the shortcut here, if you're looking for a quick answer, unless you are required to be registered in more than one state, registering exclusively in the state you reside in is the best choice 99% of the time. Multiple state registrations can be complex in nature and expose business owners to multiple taxing jurisdictions, regulatory requirements, plus more annual fees, right? Now, let's go for the long answer now. First, you need to determine where your business's home state is. So the home state is generally where your main operations are. And typically, this is the state where you, the owner, live. And so after determining the LLC's home state, you will prepare to form the business. And so LLCs are formed by filing documents with the Secretary of State. So you should obtain any additional business licenses for sales taxes, employer payroll withholding, or based on location also. Second, you need to determine what states you will have additional operations in. Okay, and so if you determine that you have a physical presence or a nexus in another state, you do not need to form a new LLC in that state. Most states offer registration as a foreign qualification, a foreign entity, or as an LLC qualifying to do business in that state. So this is kind of important to really think about it that way. And one thing I want to say here is that LLCs have the option to be taxed at the federal level as an S corporation. So you can also change, or even a C corporation for that matter. And so generally, state tax laws aligns with federal tax laws regarding the pass-through taxation of S corporation. Okay. By the way, boss, welcome back to the show. It's really a pleasure to have you here. Make yourself comfortable. You are going to enjoy today's conversation. So I gave you the shortcut. Now I want to give you a detailed explanation so you have a clear idea if you are a multi-state LLC where to pay taxes. Okay. First of all, when you operate an LLC in multiple states, you need to learn some information about operating in the new state to know what the tax impact may be to you and your LLC. You will need to do some research, and it is recommended again to actually consult with a tax attorney or a tax professional to learn the state laws and rules regarding things like registering your business taxes and fees, sales tax, and income tax. Okay, so when we talk about registering your business, it's important to really understand where and how to register and the form of the business that you want to go with. So you want to go with LLC, that's for sure, but you got to have the right form. Okay, so we got to also think about the business tax and licenses. So most LLCs do not pay income tax at the business level, as most are pass-through business entities. Sole proprietors, LLCs and entities taxes as an S corporation they're all pass-through entities, meaning the income of the business passes through to the owner and is taxed at the owner's tax rate. And so, but there are some states though where you may have to, if you're an LLC, you may have to account for taxes and fees owed by the business itself for operating in a business, like operating a business in a particular state. So you have things like gross revenue tax, and you also have business license fees. So a gross revenue tax is a tax on business gross income, meaning before expenses are deducted. So Washington State has a business and occupational tax and B&O tax, which taxes a small percent for most businesses. It's between 0.5 and 1.5% of the gross income from the business. Ohio State has a commercial activity tax, a CAT tax, for the privilege of doing business in Ohio. Businesses with gross receipts of $150,000 per calendar year or more must register for the CAT, and out-of-state businesses who meet certain criteria and have a high, like a bright line presence in Ohio, they have to pay the tax as well. So it's one of those things where you have differences. And you also have business license fees. but those actually vary from state to state and even city and county. By the way, boss, I want to quickly remind you of today's topic. We are having a conversation about LLC taxes when operating in multiple states. What about sales and use tax? Let's talk about that, okay? If you have an LLC and you're operating in multiple states, you got to really account for that. So if you sell products, you very likely need to collect and pay sales tax for the state local area of the purchaser's address or to your own state. And most businesses that sell products need to register with the sales tax authority as a seller, okay? And the thing is that each state defines for themselves what type of sales require collecting and remitting sales tax. And most often, this definition will include tangible products or certain types of products. Let me give you an example. Some states charge sales tax on all products, but others may not tax certain types of clothing and food that are considered necessities. And some states subject certain services to sales tax as well. So every state, what we have seen in our research is that every state has their own definition of use tax, and it's important to confirm for the states your business is operating in. So use tax may be charged while sales tax was not collected from the purchaser. And use tax can also apply to purchases made out of state or where a purchase would not have originally been taxable, but is used in a way that makes it taxable, okay? If you actually produce or sell products internationally, you may be subject to other countries' tax, including value-added tax, so that the VAT. So a value-added tax is a consumption tax assessed on products as they go through the supply chain. And sales tax is incredibly complicated, so always consult professionals if you suspect you owe sales tax or to confirm you do not, okay? You also have to think about local sales tax. So most sales tax is collected at the state level. However, local governments can collect sales tax in some places. For example, in Colorado, a county can set up its own sales and use tax. And if you sell to someone in that county, you are required to collect and remit the appropriate tax. But there are some states without sales tax. This is really good. You have 5 of them. You have New Hampshire, Oregon, Montana, Alaska, and Delaware. So they're actually known by the acronym NOMAD. So this is kind of cool. You also have selling platforms. If you're selling online, consider using a service or platform that assists with computing, collecting, or remitting sales tax, okay? Such as you have BigCommerce, Shopify, Wix, WooCommerce, and Valera. Let's talk about income tax. So in the U.S., taxpayers owe 2 main types of income-based tax to the federal government and 1 type to the states, right? To the IRS, we pay Social Security and Medicare tax, known as payroll tax for employees, and self-employment tax for self-employed business owners. And we also pay income tax, which is based on your income tax brackets. To each state, we pay income tax if that state has an income tax. And so the thing is that if you're talking about an LLC operating in multiple states, you got to really think about estimated tax when you need to pay and hiring an employee and the steps and resources you need to really pay attention to. So when we talk about employee tax withholding, when you have employees, you have to withhold and remit tax for them to represent all or a portion of the tax they will eventually owe at tax time. And if your employees are working or live in multiple states, you may need to register as an employer in each of those states. And this is kind of important to really pay attention to. So as a general rule, you need to remit tax where your employee lives and works. So if they live and work in 2 different states, you need to ensure that you know where the tax is to be paid. If your employee moves to another state, you will have to update their tax withholding according to the new state rules. And you need to understand that there are some states with reciprocal agreements. So this is kind of cool. So you are able to, because federal law prohibits 2 different states from collecting income tax from the same taxpayer. So some states have reciprocal agreements that clarify which states will get the tax. And usually this means that if your employee lives in one state and works in another, they only need to pay tax where they live, as long as the employer will only withhold tax and remit it to their state of residence. So for example, Arizona has a reciprocal agreement with California. So if an employee lives in California and works in Arizona, a form can be filed with Arizona to not withhold Arizona state tax. This is really good. And so you also have cases where there is no reciprocal agreements. And you also have to think about business owner income tax. And it's one of those things where you have to understand what really works for you. There are actually 9 U.S. states without income tax. You have Alaska, you have Florida, you have Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington State, and Wyoming. Boss, I want to quickly remind you of today's topic. We are having a conversation about LLC taxes when operating in multiple states. Let me share with you the approach you need to really think about when we talk about multi-state businesses. If you are an LLC, you have choices with pass-through entities and state income taxes. You do have flexibility, okay? So it's one of those things where you have to really understand that it's all about how you organize yourself, okay? So pass-through entities are partnerships and S corporations. LLCs, which are reported as partnerships or S corporations, are also pass-through entities. And in most cases, these entities do not pay federal income taxes, but rather pass through the income to the entity's owners. I've already established that. Now, the owners receive a Schedule K-1 tax documents that provides information on how to report income and deductions on their federal and state income tax returns. So while it's possible for income to pass through multiple entities before getting to a tax-paying owner, such as an individual or C corporation, individual owners are the focus of like all the LLC filing their taxes. So you need to understand that some jurisdictions, such as Texas and Washington, D.C., assess tax based on income to the entity itself. So your LLC must pay taxes to Texas and Washington, D.C. So the LLC is treated similarly to being a C corporation, as the income is not passed through to the owners of the company for taxation. So most other states require the entity to pass through the income to the owners. In this case, what happens here is that the LLC owners, the LLC members, if you will, have to file and pay income taxes in each state in which the entity does business. So when we talk about LLC taxes when operating in multiple states, we're speaking about basically the LLC must file taxes in every single state where the LLC is deriving revenue. Okay, and so the most common requirements imposed by the states is for the entity to withhold income taxes at a percentage of the state's apportioned taxable income and remit the withholding to the state. And the LLC owner, the LLC member, can actually can then claim the withheld taxes as the payments on the state return the owner files. So much like withholding on wages is claimed when filing the income tax return for the year, okay? And so this is kind of important. So while the withholding requirements likely applies to non-resident owners who are individuals, states actually vary on whether withholding is required on non-resident owners, which are basically LLCs and other entities. So when we talk about LLC taxes when operating in multiple states, it's important to really understand that some states require withholding, a composite or a non-resident owner's affidavit, okay? So it's important to understand that basically affidavits are actually the easiest at the company level, but require the most work at the owner's level. So the owner will be required to file a state tax return and possibly estimated tax payments throughout the year. So depending on the states, withholding is often the next easiest at the company level, but owners are still expected to file returns with the state. So it's one of those things where you have to really see what really makes sense for your LLC, not only in terms of operation, like not only operationally speaking, but also fiscally, but also financially speaking also. So the amount of withholding required for the year is generally determined on the annual state return filed by the entity. So your LLC will have to determine that. Only some states, such as Maryland and Ohio, require quarterly estimated taxes to be paid at the entity level. Other states, such as Virginia and North Carolina, do not require quarterly payments for withholding taxes. Okay, so what happens here is that the owner files a state return and claims the amount of withholding, and this is kind of cool. And often what we have seen in our research is that the withholding paid by the company will equal or exceed the owner's tax liability for the state, so no additional payments are due when you really think about it. And if withholding exceeds the tax liability, the overpayments may be refunded to the owner. And this is kind of important to really think about. And the overpayment will be refunded when the individual return is filed at the end of the year. So it's one thing I want to say here is that taxes paid to states other than the owner's state of residence, either via an individual return or via composite return, should result in a credit on the resident state return. And the amount of the credit will be the lesser of the resident state tax or tax paid to the owner to the other states on the double taxed income. So you have flexibility there in terms of LLC taxes when operating in multiple states. Let me give you the decision you need to really think about when we talk about LLC taxes when operating in multiple states. The big question is, can you incorporate in multiple states? No. Although your corporation or LLC can register and do business in multiple states, you are only allowed to incorporate in one state. Okay, and so this is really important from a tax perspective. Though it doesn't mean you have to pay taxes in only one state. No, you are required, if applicable, to pay taxes in all states where your LLC is operationally active. Okay, so basically, even though LLCs are governed by state law, basically you have to file only one consolidated form with the IRS. But with each state where you are actually present, you need to pay taxes. One thing I want to say here is that you always have to make sure that your LLC abides by all the other requirements. So when we talk about today's conversation revolved around taxes. That I understand, but you have other regulatory directives that you need to follow. For example, states sometimes they want you to file an annual return every single year. So basically, if you don't send an operational return, you may actually lose your LLC license, and you may not also have the ability to receive from the state something called a certificate of good standing. So filing taxes is great. It's a way for you to comply with state directives, but you have other stuff such as having a registered agent in the state, such as basically also withholding and remitting payroll taxes, either monthly or quarterly, depending upon the schedule that you are on. You may also have to ensure that you are complying with things like business licenses, things like fees, all that kind of stuff. Insurance also, especially if you are in a sensitive field such as healthcare, and your LLC is required to have insurance to actually carry certain insurance products. The state will also pay attention to that to make sure that you are in compliance there as well. So, of course, we talked about LLC taxes when operating in multiple states, but we also need to think about LLC expenses when operating in multiple states, or LLC regulations or LLC compliance when operating in multiple states. So every state has different rules and laws. So just make sure that you are in compliance with all the laws, if you will, in the states where you are currently conducting business. Thank you so much for your attention. I really appreciate it. In today's conversation, I was just talking to you about LLC taxes when operating in multiple states. And so let's do a quick recap here. So I give you the shortcuts and then detailed information. So we talked about registering your business tax and licenses, sales and use tax, income tax, and also give you an approach and the decision you need to really think about before actually filing your LLC taxes when operating in multiple states. Thank you so much for your attention. I really appreciate it. I'll see you next time. But until then, remember, stay marvelous.